Welcome back. You're watching Crystal Ball. I've been in conversation with Mahesh Nandurkar of CLSA. So you spoke about your expectations for the next 12 months. But what if you were to look out maybe say 2-3 years down the line? Do you have the confidence of forecasting a cycle at this point in time? Because, you know, in the past we would have these 5-year bull and bear cycles and investors could take a call, but now that kind of straight line forecasting seems fraught with far more hazard, and you have a very good year, then you have a couple of pedestrian years, and then again you have a very good year. What is your level of confidence in predicting some kind of a cycle out here in terms of earnings and market performance?
Yeah, so the thing is, today the Indian markets are also much more integrated, with the global environment and the global markets. Almost 23% of the total market cap of the Indian stocks is held by the foreigners. So the level of integration is actually much higher. So when we talk about cycles, we have to take into account two cycles here. One is the global liquidity cycle, and second is the Indian economic cycle. I think both of these factors have to be taken into account. Now, I am actually quite confident that if you talk about the latter one, the Indian economic cycle, then that will definitely be on an upswing, and we would definitely be in a much better position 2 or 3 years down the line as compared to what we are today, and thanks to variety of the government initiatives, and also we are currently going through a down cycle on the investments, as we discussed earlier, and the property markets have been quite weak and declining, both on the price front and the volume front. I feel that give another 2-3 years and there will be fair amount of strength that you will see that will be beginning to be visible on the property markets in general, and therefore the investment cycle as well. So on the 3-year view, I would be very positive on the Indian economic cycle looking better than what we are today. Now the second and probably an even more important factor is the global liquidity cycle. Now the thing is, one could easily argue that the current global liquidity cycle is clearly amongst, at the most beneficial level that we have sort of seen. And the best case is that this thing continues for the next 3 years. One can't be expecting improvement in the global liquidity cycle from here on. And the chances are that we will actually see the global liquidity actually worsening. So that is actually the one big risk that any of your investor will need to keep in mind, that with a 3-year view, the global liquidity cycle is the biggest risk, and there is a good chance that the two may be able to offset each other, and therefore even if the Indian economic cycle might look much brighter 3 years down the line, the total market returns over the 3-year period might still be just about average, or close to 8 to 10% or something like that.
Interesting point, but just one quick word on what your global analysts are telling you, Mahesh, now, because there is another cycle which is the EM versus DM cycle, and they also take alternate patterns. Sometimes DMs do well, as they have in the last few years compared to emerging markets. Do you get the sense by talking to a lot of people that they might be coming around to the view that the next few years might actually belong to emerging markets after this fairly serious disappointment as an asset class over the last many years?
Well, yes, that can definitely happen, as in the trade working in favor of emerging markets as against the developed markets, and that will definitely happen if this current liquidity environment continues to remain that way, because the growth in the developed world is clearly not that encouraging, and any incremental money that gets printed in the developed world is most likely to see its way into one or the other of the emerging markets. So so that EM versus DM trade once again hinges back on the liquidity cycle, as we talked about. Now our house view is that slowly we will be seeing the interest rates being hiked in the US. We are expecting 1 25 bp rate hike in this calendar year and 2 more in the next calendar year. So the thing is that under that kind of an environment, it will be difficult to see how the EM continue to outperform in a very large way, as compared to DMs, or especially the US. Maybe the European markets or the European situation doesn't look as promising, so there could be some flows coming in from that side. But at this point in time, I would probably say that in the near term it makes sense to be in EMs vis-a-vis DMs, because like as I said before, in the near term our base case is that the liquidity will remain solid, but it's difficult to take a call like that over a 2-year or 3-year period.
Mahesh, always a pleasure. Thank you very much for taking time out today.
Thank you then. Thanks a lot.